Lately, I've been getting quite a few questions about investing money into REITs. I have no idea why, but if I had to guess, then it has something to do with the skyrocketing real estate prices as of late. In this video, I'm going to go through some of the pros and cons of investing in a REIT, when it makes sense to do so, and where you should actually be investing in REITs. Because if you invest in them in the wrong place, then it's going to cost you some money. I also wanted to get an idea of how an investment portfolio with a REIT will perform. So I also backtested a couple of different portfolios to show you how things would have turned out. After that, I'll of course give you my final thoughts on what you should do. Hey, I'm Jarrad, and on this channel we talk about investing and financial independence. A real estate investment trust is a company that buys, sells, and holds physical assets that sit on some sort of land for, of course, real estate investing purposes. Sometimes they're involved in mortgages as well, but that is a very small amount of them. There is a ton of different REITs out there. Some focus on making money through the buy and sell side, some focus on the buy, hold, and rent side, and some do a little bit of both. On top of that, each individual REIT will sometimes specialize in a certain sector within the real estate ecosystem. Think of things like hospitals, grocery stores, restaurants, shopping malls, cell phone towers, office buildings, casinos, and anything in between. These REITs are publicly traded on the stock market for investors like you and me to put our money into. This is a great way to diversify your overall portfolio into real estate without having to handle the day-to-day work of managing the physical assets. There's three main reasons people invest in REITs. The first is to diversify some of your overall portfolio into a different asset class like real estate. Because real estate is its own sector, it's not as closely tied to other stock sectors. For example, like tech stocks such as Apple or automotive stocks like Ford. So if we see other sectors tanking in price for whatever reason, the price of your REITs might be unaffected or not affected as much. If we compare a REIT index to a total stock market index since 1997, we can see that a REIT index will go through periods when it outperforms and underperforms the market during that time. And if we look at the performance over the past 27 years, we actually see that returns are pretty darn close, with the total stock market returning just a little bit more. A $10,000 investment would have turned into $130,000 if it was all put into REITs, and $157,000 if the money was put into the total US stock market. Will this continue though? Who knows? The point of potentially adding a REIT into your portfolio might be to protect some of your returns if other investments in your portfolio underperforms during a certain period of time. Other than that, if you want a little bit more exposure to real estate beyond what you currently have, then a REIT can achieve that for you. But if you have money invested in a total stock market or S&P 500 index, then you already have exposure to real estate of anywhere between 2 to 4%. So keep that in mind before blindly adding a REIT, because you might already be covered. Real quick, if you could do me a huge favor and Hulk smash that thumbs up button, it really helps support this channel and of course my dog Molly. The second reason to add a REIT into your portfolio is for liquidity. If you want to invest in real estate, then you can either buy physical real estate or a REIT. In my opinion, physical real estate is the best option of the two, but the problem with it is that it's not very liquid. You'll usually need a large amount of cash for a down payment, and there is a steep learning curve. I can't just go sell my house tomorrow and have that cash show up in my account that day. The process takes weeks or even months. But with a REIT, you have access to your money as quickly as you can press that sell button, since they are traded on the stock market. If you're investing in a REIT, then I'd say to try to treat it like physical real estate, where you're not trying to get in and out real fast to make a quick buck. But it's always nice to know that you do have access to the cash if there's an emergency and you need it. The third reason people love investing in REITs is for those sweet dividends an investor receives. REITs are known for paying out pretty healthy dividends every quarter or sometimes monthly. This is a great way to get a consistent passive income stream going. But don't just go investing all of your money into REITs for the passive income through dividends. I'll explain why in just a minute. The big reason real estate investment trusts can pay such high dividends is because by law they are required to distribute 90% of their income after expenses to shareholders. This rule makes it easier for them to promise a higher dividend. On top of that, these REITs are usually receiving a consistent cash flow from their tenants and have those tenants locked into longer term leases. This will translate into a steady stream of cash flow every single month. For all of the great things that we can say about REITs, there's also some downsides as well. Now, these aren't the be-all, end-all reasons to avoid them altogether, but it's just things to know about. If we think about real estate in general, the price of it is impacted by interest rates that the Federal Reserve chooses. Since most of these REITs are going to acquire more assets through debt, when interest rates rise, it becomes more expensive to borrow that money to purchase additional properties. The Fed has kept interest rates extremely low low since the housing market crash in 2007, which has helped increase the price per share of publicly traded REITs. If, or should I say when, they decide to start increasing rates again, we might start to see the price per share for real estate investment trusts take a hit. Over the long term, the return on your REIT will be fine, but in the short term, it could look a little bumpy, so just be aware of that. The other thing that I think is overlooked a lot by investors is the taxes that you'll pay for the dividends received from investing in a REIT. You as an investor will have to pay ordinary income tax on the dividend distributions, even if you decide to reinvest that money back into the REIT. So if based on your income, you're at the top of the 12% tax bracket, the dividends received from your REITs could potentially push you into that 22% tax bracket. While on the surface, this doesn't seem like a big deal, it is from a return perspective. These taxes you pay whenever dividends are distributed to you can have a tax drag on your portfolio, which will reduce your overall returns on that investment. The good news is that there's a little workaround when it comes to investing in a REIT. To avoid paying the ordinary income tax every year, you would want to hold REIT investments in a tax advantage account like a 401k, IRA, 403b, or even an HSA. That way you're not getting a tax bill every year for the dividends that they pay out to you. Try to avoid investing in a REIT or any very high-paying dividend stocks within a taxable investment account unless you really know what you're doing in terms of the tax liability and strategy. When I see people holding high dividend-paying stocks in a taxable investment account, it makes me cringe because it's costing them a lot of money in taxes every single year. Another thing to keep in mind when picking a REIT is don't just choose one because it pays a high dividend. While high dividends can be great, if it looks too good to be true, then it most likely is. You'll need to look deeper into the fundamentals of the REIT to see if that dividend yield is even sustainable long term. If it's not, then they can change it whenever they want. Here's two examples of REITs that had dividend yields in the 20% range for a short period of time until it eventually came back down. Doing your due diligence on an individual REIT stock can be time-consuming and even confusing sometimes, but the good news is that you can still take advantage of this investment class using a REIT ETF, which makes it way easier to evaluate. A REIT ETF is a fund that holds a bunch of different individual REITs within it. So instead of buying, say, Crown Castle, Store Capital, or Simon Property Group stock individually, you can just buy a REIT ETF like the Vanguard Real Estate ETF, which holds those 3 stocks plus 170 others as well. Full disclosure, I'm a little biased when it comes to ETFs because I love them over individual stocks every single day of the week. But if you want to invest in the REIT stocks individually and you know what you're doing, then go for it. Above my head and at the end of this video, I'll have a link to a video that I made on how to analyze an ETF before you buy it. When it comes to backtesting different investment portfolios, I had to make a few assumptions. So keep in mind that mileage may vary based on how you would construct a portfolio on your own, but this is what I came up with. Instead of investing a lump sum at once to see how it would turn out, I wanted to take a little bit more realistic approach. Since most of us are going to be investing money every single month, I set up the backtest to account for that. I chose $500 per month to simulate something like maxing out a Roth IRA every single year. Because the max contribution limit is $6,000 divided by 12 months, that makes it $500 per month. The first portfolio is what I'll call our control portfolio. I have 100% being invested in the total stock market like a VTI. The second portfolio has 80% in the total stock market and 20% in a REIT ETF. The third portfolio is a little bit of a play on the 3-fund portfolio, except I pulled out the bonds and replaced it with a REIT ETF. For that one, I have 70% in the total stock market, 20% in international, and 10% in a REIT ETF. The returns for all 3 were within 1% of each other. The only one that lagged behind the most was the 3-fund portfolio, but that was mainly because of the 20% international exposure, which dragged down the returns. If we had increased the REIT allocation to, say, 20% and dropped the international down to 10%, then it would have performed just a little bit better. As always, with any sort of backtesting, there is no guarantee everything will play out the same way going forward. I personally left my crystal ball at my ex-girlfriend's house, and she of course won't give it back, so I can't tell you what the future looks like. I don't think there's any hard and fast rule as to whether or not you need to own a REIT. It's mainly going to be personal preference. If you feel like you want more exposure to real estate, then go ahead and invest a certain percentage of your money into one, but I probably wouldn't make it a larger allocation within your portfolio. Also, double check to make sure that you don't already have money invested into real estate within your index funds, because I bet you already do. This is just my opinion, but if I had to add a REIT to my portfolio, then I'd do it through a REIT ETF as opposed to picking a REIT stock individually. But that's just me though. Make sure to Hulk smash that thumbs up button before you go. Check out the description to get some free stocks as well as more resources and playlists to help out with all of your investing and financial independence needs. I'll see you in the next one, friends. Done.